Okay, well, in the interest of time, we'll go ahead and kick things off. Thank you all for joining us today as we round out 2023 and look ahead at 2024. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. We're really excited today to have some very familiar faces. Join me in welcoming our guests and various members of the CWDL Dream Team. We have Lucy Turek, Senior Tax Manager, Austin Kep, Senior Audit Manager, Nadia, I'm going to do it right here, Sahadeo, Senior Manager, Dustin Pfluger, Partner at CWDL. They're all going to take a look back at 2023. Thank God, goodness we're looking back, and take a look ahead into 2024 and look at what changes are coming. Couple of housekeeping items. We like to make this as interactive as possible, so please feel free to ask questions in the chat. If we don't get to them, we'll definitely circle back with you. With that, let's get started.
Okay. Thank you, Casey, and thank you, everybody for joining here. I know it's some of y'all's first time on this and some new faces for the firm to be on. So thank you all. So yeah, I think, kind of like Casey said, to kind of, get going and kind of talk through, what we're going to kind of run through is just, this is different from our other ones. Typically we have, some external, experts on from other companies that kind of share. We typically usually close the year out with our own webinar and just talking through, some issues from 2023, but really looking forward to kind of the tax, audit, and accounting issues, going into year end and into audit season and new accounting standards, new issues we're seeing, some different stuff like that. So I guess with that, I mean, we'll start with the tax side of things. Get started there, and then kind of from there walk through the kind of year end closeout procedures, how to make an efficient audit, how to make efficient financials, that kind of stuff, and then a few accounting changes, some stuff we're hearing from LEAP and HUD and GNMA and some different stuff. So that's a little rundown of what's gonna happen, how it's gonna work. And like Casey said, please jump in if you have any questions, if there's anything going on, anything that you want us to clarify. We'll try to answer questions here. If we don't get to it, we will follow up with an individual email if it's too long. So I guess with that, let's just jump into tax, Lucy, and just kind of talk, just in generalities first, and just kind of talk about general, year-end, tax plannings, what we can still do for the rest of the year, and just just a general overall kind of what we should be doing in these last few weeks of the year.
Cool. Well, thanks, Dustin. Glad to be here. Some of y'all, clients, we've done like year-end tax projections with y'all, and if we haven't, we probably are trying to schedule that with you in the next week or so. A couple things to keep in mind for C Corps. The 1120 Q4 ESs are going to be due on the 15th. So some of y'all, I think we still are trying to get those to today, but otherwise make sure those payments are made. Most of the state payments will not be due until January, so you have a little bit of time. A couple other December things to keep in mind. So if you haven't set up a 401k plan and you want to, you at least have to set it up by 12/31. Employer contributions aren't going to be due until the extended due date of your return, but you want to make sure the plan's actually formulated. Then let's see, employee contributions, so 401k, payroll deductions, anything that you want to do, whether it's for yourself or your for employees, to reach the max amount, which is 22.5 for employees this year with the 401k. Make sure that's on your last payroll run. Let's see, IRA contributions are not due till April 15th, so you have a little bit. Couple other like year-end strategies we're talking to people about. So accelerating some expenses, deferring revenue. So any of those prepaids that you maybe normally pay in January that you could go ahead and pay in December for the next 12 months. You could do that. If you wanted to defer revenue, wait on some invoices. I'm trying to think.
So I guess go back one step. Going back to one step, something you mentioned here on 401k contributions, that kind of thing. So you said you had to have that set up. So what you mean you have to have it set up by the end of the year, but you can make contributions up until the April 15th deadline? That's what you said into it?
So the employer contributions are gonna be, they would actually are until the extended due date. So if your calendar year, that could be all the way to September, or October, depending on if you're S corp partnership, C corp. So, but you just need to have the plan in place. So if you have financial advisor, if you need one, we can obviously refer that. But employee contribution to be made by this last payroll. So if you were going to write yourself the max amount on this final paycheck, make sure that it runs through 12/31.
Okay. Okay, are there any other, I mean, aren't there some other expenses too that like need to be paid out? I mean, there's some like bonuses and stuff like that. This may not be a year we're talking heavily on bonuses and whatnot, but there may be a few clients out there. We have a few that made some money, but some bonuses, they can accrue bonuses at the end of the year. They just have to have them paid out within a certain amount of time of year end, correct?
Yes. So 90 days, 3.5 months. Normally that's the thing that when we go through the audit process, we would then ask, like, have you paid it within this period? Like we're saying, most people are seeing losses this year, so they're not necessarily doing that. But definitely, if you are planning on doing that and have questions, give us a shout. We can let you know.
Okay.
The other thing I didn't touch base on that I was going to make a note of was just the harvesting of losses. So like if you did have some capital gains by the end of the year, either within the entity or as an individual, time to do that before 12/31. So just something else to consider.
Okay. So on the, and we may get into this in here in a second too, on the tax the tax jobs cut act, the Trump tax bill. Here and then
That one,
stuff
yeah.
expires and stuff like that. But with losses and loss carry forwards and stuff like that, aren't there some rules, some changes in that? I know the last couple of years have probably been big NOLs and some carry forwards. Are there some rules on how much you can carry forward when, or how much you can use in future years and that kind of thing?
Yeah, so in 2022, part of that was the 461 excess business loss limitation. So prior to TCJA, could have taken large losses in the year that they were incurred. And so now you're actually limited, even if it is a non-passive activity. So if you are the owner or partner of the partnership and you're actually limited, 2023, it's 578 for joint, 289, and we're talking 1,000 for single. And then it's just changed for inflation. So 2024, 610 and then 305. But basically, you're just going to be capped at that loss. And then you can roll forward any that you can't take. But basically, if you have a loss of a million, you wouldn't be able to take all of it in that same year. So, which is different than maybe what you're used to in other years with losses.
Okay, I guess like moving on again, staying in taxes, moving on. I mean, I guess let's just run through some new or legislation, anything that's been passed in the last few years. Really focus on what's going to affect, our mortgage companies, our owners of mortgage companies. Yeah, I guess kind of just talk through anything new that you've seen in the last year or two.
So the big thing would be like the 461, that's a pretty big deal, especially this year with the losses. So, in 2020, 2021, that wasn't really a factor. This year, that is a big deal. The SALT limitations, like the 10,000 is going to expire in 2025. Another thing, just kind of for anybody, not necessarily even a mortgage, is the past 2 years we had 100% employee meals due to COVID and things like that. So now 2023, it's back to the kind of typical 50%, unless it's like a holiday party or stocking or common area. So just something to kind of consider. And then kind of the big ones obviously is the bonus depreciation. So prior to 2023, we were getting to do the 100, and in 2023 it's now going to drop to 80 and then continue to phase its way out until 27. So a lot of people, when we're looking at tax projections and looking at your balance sheet, seeing those investments and purchases in fixed assets, definitely something to consider which in my opinion is actually good. So if you have a loss, to not have to take all of it, now might actually be beneficial, so.
Got it. Got it. I guess the other one too, the other one that's been a big hot topic and you know, just we talked briefly on, I know we've talked about it a lot this year. I think all the CPA firms is just the ERC credit and kind of what we're seeing, you know, just overall. I mean, I know there's been like a moratorium on them and stuff like that, but I guess overall what we're seeing, and then we can talk a little bit specific to the mortgage space.
So really halt, like you were saying, they just put out a thing that the IRS said that they were getting flooded by a bunch of kind of bogus applications, and so they're going to put all that on hold, and they basically kind of sent out a, you know, warning that they're going to go back through with those who have, even if you already received the credit, even if you think, you know, I was fine, they're actually going to go back through and kind of look at ones that have out, ones that they did pass. So they kind of sent out a thing that said, be aware that we might be sending out an initial round of, I think they said like 20,000 letters to people that actually shouldn't have claimed the credit. So I don't know that most of our people, I feel like, you did their due diligence if they did it at all. So.
No, and generally, I know we've talked about this before, but generally, you know, speaking, you know, you know, we believe, and I think most of the firms that specialize in the mortgage space out there believe, you know, it'd be a hard case for a mortgage company to claim an ERC credit. I mean, right? Is that still kind of your thoughts, just because of the years they've had and stuff like that?
Yeah, and especially because the idea that really the whole credit, if you think about it, where it stems from, is the idea of not being able, you know, to work, having to pay extra to keep people on when they're not able to work. But we were able to work remotely. We were able to, you know, everybody obviously had a hiccup, but like versus other industries, it was probably better, easier to get back on our feet. But I know that there are plenty of companies that kind of wooed, you know, not necessarily our clients, but other mortgage companies saying, you know, but you could qualify. So if you did, hopefully you have a nice packet that explains why you should qualify.
So I guess just quickly, and again, I don't think many people took it, but just quickly, what would be the like you know, what's the risks or the penalties, you know, if they took it and the IRS determines it's not, you know, eligible, or they weren't eligible to ever take it, I guess.
So, you know, I think it's kind of a new area because we haven't really seen what would happen, but my thought would be probably be amending those returns. They would amend it for you, and then there's going to be some probably substantial penalties and interests. If you're worried now, and I believe that we read that they kind of had a grace period of, if you think, okay, maybe I toed the line, I shouldn't have, there's kind of a almost like a, you know, come forward waiver that if you were to say like, okay, let me check, they might be a little bit more lenient. But thankfully, I feel like not too many of our clients really went down that road. But if you didn't, you're nervous, definitely reach out. So
Yeah, I think I mean, I think you're right. We may have had a handful out of all of our, you know, 100 or so mortgage banks to take the credit. So yeah, okay. I guess yeah, I guess moving on a little bit. Still just sticking with tax for the time being, and then we'll jump into some other things here in a second. But you know, with the Tax Cut and Jobs Act, you know, we talked about that, you know, briefly there for a minute. But what I mean, give us some of the key benefits. I think you talked through some of them. I mean, like meals deduction. I mean, is there anything else we missed, you know, that we should cover here, just so people are
the other
aware?
one I do mention is the R&D expenses. So that's still going to stay around, that amortize versus expensing. I know we law with that. Last year, we definitely recommended to clients, especially in a lost year, to maybe do an R&D study. I think sometimes that topic seems kind of overwhelming, or, you know, we're not creating new products or being inventors, but especially when it comes to creating your own software for your, you know, either on the lender side or even on the customer side, you know, really creating your own templates that they use, that is really considered part of the R&D. So that's just something that we've been talking to people about. It may not be worth it. Sometimes the time and the effort isn't worth it. but it definitely is worth giving it a chance to just see, like, it's, you know, pretty much free, I feel like, to see if you qualify. So that's going to stay the same, I think, until 2027.
Got it. Okay. Okay. I think, you know, moving on, most of our mortgage companies, you know, are, you know, obviously multi-state, you know, file in, you know, every state, so a lot of them. So I guess just, I mean, talk through it. I know there's some specific California PTE stuff. I mean, other states, there's issues. So I guess
Yeah,
just
so
kind of talk through.
specifically for flow through entities, so partnerships, S corps. So this next part doesn't really apply, or doesn't apply at all, to C corps. So the PTE, the pass through entity credit, basically allows you to expense, you know, the state taxes at the corporate or the entity level, not corporate, entity level versus the individual, because of the SALT caps of the state and local tax 10,000. So basically, a lot in state tax that could be beneficial. So just a couple of dates. California, the first payment would be due June 15th. Places like Arizona, the actual election is not due until the extended date of the return. Basically, we try to look at flow through entities and see what are the states that you probably have the biggest tax liability. So it doesn't matter about doing business there, it really has to do with the liability. So you could have a lot of gross receipts or a lot of payroll, but if they're low tax state, it wouldn't make sense to go through this. But for if you actually have a huge tax liability, it could be worth looking into. And we try to look at that, like, this part of the year to see, okay, so far you may owe a lot in these states, let's talk about it. Unfortunately, none of the states are the same about the rules, so it takes a little bit finagling on our end to figure out, like, when things are due, but definitely something to consider, especially 2024, when hopefully we're headed upwards as far as the net income goes.
Okay. You know, yeah, I think you also mentioned here Arizona. I mean, there's an Arizona PT. Did you mention that?
Yeah, so that is just due by the extended due date of the return. And a lot of states have it. Those are just ones that we're seeing specifically to our clients that, like, they may have a tax liability, but there's plenty more that have the credit. In Mexico, I mean, I think most states do if they have a tax liability. So
Got it. Okay. And I think really the last thing, and Nadia, you probably jump in here too a little bit on this one, because I think it comes with some of the stuff pulling stuff from loan vision and whatnot. But you know, Lucy, you can talk a little bit at first. But you know, 1099, 1098 reporting. Just, I mean, I guess talk through the kind of the key dates, and then maybe Nadia, you can kind of talk through how we can help, you know, pull the data, do that kind of stuff.
perfect. Yeah, I was gonna say I'll give the facts and she can give the details. So for 1099s, they, per usual, January 31st is supposed to be the deadline to the recipients. February by paper to the government, March of electronic. 1098s are due to the recipients by January 31st, and then e-file to the IRS by March 31st. So my understanding is those dates are not any different than they have been in the past. So no changes there. But Nadia, maybe you want to speak a little bit about how to get that to us to prepare, or what they need to do to get those out the door.
Yep. Well, thank you, Lucy. Thank you, Dustin. The 1098s and 1099, you want to, for 1099, you want to make sure that you have your vendor management is all set up, right, in your accounting system. You want to make sure that all of your payments are recorded. All your payments to your vendors are recorded at a vendor level. So now in your accounting software, so now it's easier to extract that information from your accounting software, such as A&B, Loan Vision. You know, there's a report that you can use that you can just easily transform it to an Excel spreadsheet and get that data over to whoever's printing out the 1098s for you and submitting it. 1098s, you would actually get it from your Encompass or your LOS system. You know, you could extract it. We have templates that you can use, and you extract that information, and basically you want to make sure that you enter all of your borrower's payments in that LOS system. and whether it's your interest that you're collecting from your closing, interest that you're getting from your borrower's payments, escrows, any of that information is logged into your LOS. And it's a simple extract.
And I think you made a key, comment there. Nadia, it's kind of all about like kind of the data hygiene, the underlying, data and stuff there. Because I mean, even if we're doing it or helping extract the data, or if another vendor is, or they're doing it internally, it's all about what's in the system and what's put in there. And I know we had a couple issues, last year, pulling data, or had some clients asking us some questions about, and it was because some boxes were left blank or whatever. And it's basically it's an automatic process, right? You pull it out, you either run a report from, Loan Vision or Encompass or AMB or whatever that kind of gives you all of that data. Correct?
Correct.
And
Yes.
yeah,
You can
and
build
then
a,
that gets,
you could, yeah, you can build that report straight out of your either LOS or your accounting software, and you get that. But it's really important that you do maintain your vendor information in your accounting software with their the ID, and the addresses and stuff like that. So it's an easy extract. Yeah.
the data, and it is just the data that goes in is the same data that comes out. I mean, similar to hedge reports or anything like that. That if you're not getting the right data in there, it's hard to make everything else work. At least on an automatic basis. It would take a very manual process to go through everything and make sure everything's manually ticked and tied and all that kind of stuff. So yeah, I guess moving into just other year end stuff and issues. Nadia, I mean, just I guess overall, just tell us just high level what you've seen. Kind of I mean, you have a unique perspective. Austin and I, and even Lucy, come from the other side where we're getting all the data. We're the ones preparing audits or tax returns. I mean, you and your team are the ones that are helping prepare all that data and get it to us. So, I mean, what have you seen from your side working, with auditors, tax returns? What's the best way to prepare to have like the most efficient kind of year-end process, audit, tax related, everything like that?
Exactly. So, it's the 50th week, and by now you should be well on the way, right? To get all of your accounting, discuss strategies with, your tax accountant, CPAs, attorney, banker, even your warehouse bankers. You should have an open communication with everyone to make sure you're on the same page, and especially your page, right? So if your accounting team feels like they're not there as yet, it's not too late. Just remember that you can still be on your way to gather all the information. So the first step I would recommend is getting that PVC list from your auditor. Try to get that list as early as possible. Right now would be great. So in that way, since you're closing up November, it'll be easier to just make sure everything is corrected, fixed, adjusted before you give them the final numbers when you're ready to close December. Okay, so knowing that, having that list right now, it'll just make the process go a lot easier, a lot smoother for yourself, less stressful, and it gives you plenty of time to prepare. And just remember that every item on your balance sheet should be reconciled, right? Bank accounts, your current assets, your liability, everything needs to be reconciled. So I would make sure that you look at every number on your balance sheet and be prepared to have a backup for it, not just the data dump of the general ledger. So get, most of the typical items that your auditor, what they're going to ask for. They're going to ask for your December bank statements, your January bank statements, have all of that. And the one thing that I would always recommend to all the accountants out there is to utilize the accounting software as your file cabinet, right? Whether if it's Loan Vision, AMB, even QuickBooks, you can save all of your documents in your part of your journal entries or even reconciliations. So that's a great thing about these softwares, that you can store it and you don't have to go hunting, looking for them last minute.
Yeah, I guess, I mean, Austin, I mean, I think you probably echo a lot of those, but from, your perspective, as now the auditor. I mean, what are your thoughts on, you know, both what Nadia said and other stuff?
Yeah, absolutely. Thank you, Dustin. Yeah, Nadia touched on it. I know on our end, we have a great reconciliation workbook to capture all those accounts. And really that'll help isolate problem accounts that you know you're going to have to clean up. Us as auditors, we have a way of finding those accounts and wanting to drill into the ones that you really don't want us to find. So just go ahead and start tackling those right away. You have more time now to get those figured out and solved. And again, I really like how Nadia touched on a GL dump is not a reconciliation. You know, really figure out what's in that balance, not just the full year's activity. Another good point, you know, we're approaching the end of the year. Something to be wary of or start tracking, if you haven't already, is making note of any changes throughout the year, especially key personnel, your controls, operating activities. You know, the more you have documented there, the more that we're on a head start with the audit, because we're definitely going to ask those questions. We want to be able to see what's changed, who's responsible for what, be able to have, you know, very clear understanding of who we need to go to get certain things. And if all that's documented, it makes the process much easier. Lastly, too, just there's more audit standards coming down on us, basically emphasizing our need to get the understandings of those processes and understanding the company as a whole. And so, you know, be prepared for more of those types of questions.
Yeah.
Sorry, Nadia. Sorry, you're about to say something.
Yeah, no, I was going to say also to make sure that you look at your trial balance, you know, your beginning trial, take your beginning trial balance for the year, make sure it ties into your audited financials. And the big thing that we usually see is that most new clients we see, they forget to roll over their prior year distributions and contributions into retained earnings. So we want to make sure we do that, or even simply reversing an accrual that an auditor gave you at the end of the year and it wasn't reversed in January 1st. So things like that, you definitely want to make sure you're looking at it. And then just make sure that your loan level details, you know, that you have. Any loans that are living on your balance sheet that's been sold, why do you have an open balance? Identify it. If it needs to be written off, because eventually you will go to the P&L as well, you know, so you want to make sure you look at that. So any loans that have not been sold as of December 31st should only be on your balance sheet, right? Unless there's an accounts receivable or accounts payable that you're waiting to pay on it.
Yep.
So, and because the chances are your auditor will ask you about it.
Yeah. And I think the one thing we haven't touched on really is just like, you know, if there are, I mean, in an ideal world, we're making, you know, all of our required entries every month, you know, to technically be on GAAP. But I know, you know, this year, especially with the lease standard and some other things, you know, we probably want making those, well, we may have, we may not, you know, I can't say that, but if you weren't, just, you know, remember, you know, technically for monthly financials, you should have them in there. I think it's probably immaterial to change every month, but definitely for year end, we do need to be updating, you know, the lease entries and stuff like that. And we'll get into that in a little bit down here on the bottom on the actual standard updates and stuff like that. So I think the last piece just on kind of syncing up is just, I mean, you know, Lucy, I guess just kind of, I mean, we're in a unique spot that, you know, we do, you know, tax and accounting for some clients. We do tax and audit for some clients. You know, we obviously can't really do audit and accounting and tax all together. But I guess Lucy, just, I mean, what's the best transition just from audit, you know, to tax or accounting to tax? I mean, from the client side, like what are you know, what are your suggestions, your thoughts there, type thing?
Well, I also, Nadia kind of touched on this too, and it's a huge deal that a lot of the balance sheets, you know, whether it's either matching up to last year or making your own adjustments, like, you know, open pipeline, loan loss reserve, derivative gain, that really does affect your P&L because that's the other side of the entry. So a lot of this stuff is not just so that your reports look good or that the audit, you know, you're checking that box. Really, it's that your year-to-date financials are truly, you know, a good source of something for you to look at. So that's just something to keep in mind, that it's not just a formality, like it really does help. As for the other, obviously for us, it's if we do one of the other three, because then we have an inside perspective versus if we just did your tax stuff and we didn't have any idea of the others. But most of y'all probably realize, like for the tax, there's a little bit more state information that we need that necessarily audit may not need. Details such as wages, salary, gross receipts by state, and also just to let us know. I mean, we try to check in with this, but part of the PTE, but also just for state filings and state quarterly, let us know that this year I'm doing a ton more business in Arizona, and last year we only had one loan officer there that was working remote. Those kind of things, keeping us ahead of the game for that is always better versus next April when we're talking about extension and it's like, oh my gosh, we see that you've been there for 12 months. Just kind of keeping us in the know, but definitely for us, it's easier if we do the HUD or the accounting because they kind of already get the heads up and they can let us know. So most of the time it's just a little bit more state details, kind of the different stuff that we need, breakdown of state taxes, that kind of stuff.
Okay. I guess going a little bit, we have a couple or a few unique, challenges this year. We have some changes with GNMA, some changes in the obviously just in what's happening in the industry. I think probably the biggest piece is going concern, and that it was a big issue last year. It's probably going to continue to be a big issue this year. So I guess Austin, that why don't you talk a little bit just about the process of going concern, how it's kind of a two-step process, and just very high level. We're also, so everybody knows, we do plan to follow up this email follow up this webinar with a kind of like a key topics for our clients, and especially on the audit and accounting side, like kind of, hey, here are the key like things for this year that did change that you should be just looking at what we're going to be focused on. But yeah, go ahead, audit. Austin, why don't you talk just a little bit about the process for going concern?
Sure, absolutely. And it's kind of unfortunate, the state of things, that we're having to discuss going concern, but that's just the nature of where we're at. Like Dustin mentioned, it's a two-step process. The first being really just you assessing whether you do have or you're trying to address it. So really, if you're having ongoing operating losses, if you're seeing negative trends, or you feel, you have a lack or limitation of liquidity to cover your ongoing operations, things like that. You really need to drill in, forecast out, aggregate what you feel your future obligations are, compare that to your current expectation of where you'll be across the next year. And if there's a deficit there, for step one that you have a going concern issue. And so if that's the case, then you really need to go into step two. This is where you'll consider your plans to address those issues. So the key difference here is step one does not include your plans. It's really just looking at the state of things as they are. Step two is you addressing those and then describing how, if you implement those plans, how are you going to alleviate those concerns? Are you going to try to restructure debt, equity infusions, make operating changes, things along that nature? And then really trying to forecast those out and line those up in how you're going to ensure that you address those concerns and that you can continue without much issue. And something I'd really like to point out that's kind of different with going concern is it's not as of year out from the date of the financials. So if you go ahead and get started on this, which, definitely recommend it if you feel you're going to need step one, which from our perspective, we're having a feeling that a majority or a large percentage of our clients are going to meet step one and going to need to do this step two analysis. So if you get started on that, you can do that forecast out. And then at the time or when we're approaching the financial statement issue date, you can try to roll that forward to make sure you're covering at least that year from the financial statement date.
Yeah, perfect. Yeah, and just to kind of re-stress that, step one is kind of a very low bar, step two is kind of a, higher bar, so to clear step two, a lot of clients are going to go through step one, but then to clear step two, we really do have to be prepared, have a plan, kind of talk about, hey, this is what we're going to do, this is how we're going to get there. Nadia, I don't know how much
Right.
we helped
And
on the.
even right.
Go ahead, sorry, Austin, go ahead.
Sorry, no, I was just going to say right in the standards themselves, they give you good examples of things to look for. And they specifically call out internal and external scenarios. And so, definitely looking at current market conditions and more recent performance of clients that we're seeing, that's definitely why we're feeling, that lower threshold of step one is probably going to be met by a good number of clients and companies throughout.
So I guess, Nadia, if you don't have much time in here, that's fine too. But I was just gonna, thought or question for you. I don't know how much on the accounting side. We obviously can help. Pull together the data. We can kind of, tell them, yeah, we do believe this, and we can definitely help prepare. Right. There's definitely, stuff we can help do prepare, but we also need a lot of input from from the owners, or from, CEOs, CFOs, right? It's not just like a, vacuum that we can go do all this from the accounting side. We do need their plan because we don't know, what they personally have. Right. Anything you wanted to add there, Nadia, on that, or thoughts there?
No, I would say just to review everything with them prior, you would have that open level of communication with the owner, with the CEO, with the CFO. You have to have that open communication, making sure you go through your books to make sure that, everything that you have on there is correct. Especially, all of your assets do you still have all of those on, reflected correctly?
Yeah, for sure. Okay, I guess running through some of the changes this year too, Austin. There's been some HUD and GNMA stuff. I can talk a little bit about the GNMA. But first I wanted to kind of talk about just the significant, probably HUD areas we're going to see. There's probably one or two that we'll see significant stuff. But if you kind of just want to touch on what your thoughts are on the significant findings we'll see as significant issues with HUD reporting.
Sure. So with HUD, there's really two areas of focus here. One is not necessarily new, but it's definitely of higher emphasis with the way things are going. That first one being the net operating loss calculation and correspondence with HUD if you have greater than 20% loss during any quarter of that previous quarter's equity. And so we've actually seen HUD has been in rare form actually sending out notices reminding companies of this requirement in particular. They know the way things are going and they want to make sure people are on top of that. It's just, a really easy finding for them, and they're really searching for that if you're not paying attention. And you really need to make sure that you're doing that calculation on an ongoing quarterly basis, especially if you're that deficit in operating cash flows or you're having significant operating losses. Just to make sure you're doing that calculation, and if you cross that threshold, just ensuring that you have that process in place to notify HUD and move forward with any remediation there.
Yeah, and you made a couple key points
the
there.
second word.
Sorry, Haj, you made a couple key points there. It is the requirement is a quarterly basis. It's not a year basis. Just for everybody to be aware of. But what we have been seeing with HUD is they will come back, and if they get audited financials for the year that are bigger than 20% losses, then they're asking for quarterly financials, and they're going to ask you for it, and it's a much bigger deal if you do not report that to HUD than if you report. Then you report it. If you do not report it and they find it, it's like it automatically goes to MRB, stuff like that. So just be aware of that if there is an issue. If you're technically supposed to report it within 30 days of knowing that there is that issue. So yeah, go ahead, Austin. Go with the other one you were about to jump into. He's there. we're having some internet issues. I think some people can tell. Well, I can jump into the next one too. This may be a change. There you go, Austin. You can jump back in.
Oh, there we go. Sorry about that.
No, it's all right. So some leap changes, I think, was where we're going with the next one.
Absolutely. And back to the operating loss, I think you did mention, it is so much better to show that you have that process in place and notify ahead of time than for HUD to come across and ask at the end of the year and discover that, oh, you had this and you didn't report it. So absolutely. The next major or, kind of a different type of change we're seeing with LEAP is that they are looking to require dual authentication for the data entry. And so at first glance, it doesn't seem like it's that big of a change, but again, based on the way and the process we've been doing this in the past, it's just a kind of a big hiccup now in the system, for sake of figuring out who that goes to, what that process is going to look like going forward. A lot of that data entry is being outsourced by companies, either, through auditor or others who basically input that for auditors to then, give their attestation on that data input. So just a strain of kind of different change there. And in fact, that's kind of still in the works and making sure that we can reconfigure what that's going to look like and be able to handle how that dual authentication is going to work. Basically, whether the person inputting, has to reach out and be in closer contact with who is going to do that authorization to do the dual authentication. It's still just yet to be seen. But just something to be aware of that they're changing in the LEAP system.
Yeah, and it's something, truthfully, something we've heard on some FHA trainings, some HUD trainings that it's coming down the pipe. It's not here yet, but so we're not quite sure what it looks like or how it looks, and where Austin's going to is just for most of our clients we use an external provider that then does the data input for you guys. So that process may change some. It may be clunky this year. We're not sure with this dual authentication. I think HUD is really trying to crack down on auditors doing data input because we're technically not allowed to, and we don't. We use an external firm even when we're doing the LEAP submission. We use an external firm that does the data input, and then we review and sign off. So yeah, that's that. I guess I can jump in real quick on the GNMA. I'm going to cover these quickly. Again, we're going to send out an announcement on this. And there's a lot of words here, so I don't want to, we'll get, out and get links to the guidance and stuff like that. But GNMA has gone through some major changes with their net worth and liquidity requirements, and then later down the road, some risk-based capital stuff. But basically, the stuff has gone into effect this year. Ginny has upped everybody's requirement for both liquidity and net worth. So in the past, net worth was $2.5 million base plus 35 basis points of GNMA, of the GNMA UPB, was kind of how you calculated your, what your required net worth was. Well, this year, going into effect 9/30, it's still 2.5 million plus the 35 basis points of GNMA UPB, but they're adding in another 25 basis points of GSE and even non-GSE portfolios that you're servicing. So, what that really means is that, if you had a small Ginnie portfolio, but a large Fannie or Freddie portfolio, your Ginnie net worth is going to go way up because of that 25 basis points we're adding in. Similarly, on the liquidity side, it used to be just a base of $1 million plus 10 basis points of GNMA UPB. Again, they're keeping that in, and now they're adding 3.5 basis points of, and this gets a little confusing, but basically it's either 3.5 to 7 basis points of non-GNMA UPB, and it goes from 3.5 to 7 based if it's like an actual or schedule to schedule or schedule to actual. So So just so everybody knows that that's kind of the calculation, they are upping it. So it is something to watch and be, aware of. Again, we're going to send out, something so you guys can see, in the next day or two, so you can actually see the numbers and the calculation. And I think the last thing that goes into effect, well, I guess there's two things. They are adding, again, for liquidity, they're also adding a percentage of loans held for sale and interest rate locks to the requirement. So it's basically if you've originated over $1 billion in the last full quarter. So in any rolling 12 months, basically, if you've originated over $1 billion, you need to add another 50 basis points of your loans held for sale and your interest rate lock notional amounts net of the fallout for interest rate lock. So just be aware of that. I mean, they are kind of big changes. Typically our GNMA servicers aren't close to their net worth or their liquidity, issue. So, hopefully this isn't that big of an issue. I think the biggest issue is what comes into effect in 2024, 12/31, 2024 is just the risk-based capital requirements. So there are some changes, and I'm sure it's going to change. I'm not even going to really go into it that much, but they're changing the capital requirements and their risk weighting stuff more like a bank. So they're going to take, certain higher risk assets, they're going to take those out and not give you credit for them, or give you, percentage of the, asset credit. So just something to be aware of when you're planning, into next year. Again, as more comes out, we'll send out more, and I'm sure it's going to be a focus of everything, in 2024. Conferences, everything like that, so if it's, I mean, they've already kicked it down the road one time. It was supposed to go into effect 9/30 as well, but they've moved it to 12/31 to let more people prepare for it. So those are kind of the big changes, within Ginny and HUD we're seeing. I think really the last thing I wanted to touch on, and then Mark will come on here to kind of close us out for the year kind of thing, but really is, kind of new accounting pronouncements. There's one new one that's going to impact us. We'll talk about that, secondarily. I think, lease accounting standard was new last year. But it's still new-ish. So I wanted to just kind of talk through, Austin, kind of maybe tell us kind of what we saw this year, what we saw, the hiccups, that kind of thing, and then, how to kind of, get prepare for year end on it.
Definitely. So yes, like Dustin mentioned, not new, but still everyone getting used to it last year, being the first time to implement this for a lot of our clients and companies across the board. It was definitely a learning experience, but I feel like it went well overall for sake of a lot of companies. If they didn't come up with internal, spreadsheets and everything to put it together themselves, they've leaned on a lot of technology resources for tracking and reporting under the new requirements. So something to be aware of with those that we're kind of seeing through interim and things like that is that you can rely on that technology, but you need to make sure that as things change, as you bring on leases, as you remove leases, or buy out of those different things, that you're updating those to be applicable, matching how it actually reflects what is actually happening on the technology side, whatever you may be using, and what you are doing with your leases. The second part of that is making sure that you're actually booking those entries to bring your balance sheet, income statement for the expense side up to date, and having those more ready for year end, because that can, as you probably saw last year, can be fairly time consuming going through those leases and making sure those are updated. I also want to touch base on the discount rates. There is a new standard that gives a little bit more flexibility in choosing the risk-free rate. So potentially something to consider there if you're still looking at certain implementation pieces. But in short, basically before, if you chose the risk-free rate, you had to do that across the board. Now they're giving non-public companies a little bit more flexibility in using that by classes of lease instead of having to do that at the entity level. However, for the majority of our clients, we feel like there's a good basis in the incremental borrowing rate. You have your warehouse line rates and things like that, a lot of good basis, good things to reference for use if the lease itself doesn't a stated or implied interest rate built in. To have that implied rate, you should be using that. But if not, mortgage industry, we've got a lot more resources in coming up with a good basis for that incremental borrowing rate.
For sure. So, yeah, I mean, I think just to, reiterate, I mean, I think the technologies out there really made it a little bit easier than, I mean, it wasn't by any means really easy, but it definitely made it easier. And, I think 100% of our clients are using, Lease Crunch or Lease Query or something like that to do this, which makes everybody's life easier. So,
Absolutely, especially with all the weighted average disclosures and things like
Yep.
that, because that's definitely a tedious, and it opens the door for a lot of, human error or spreadsheet error when you're, messing with weighted average across multiple leases in those areas.
So I think the last piece, I mean, really is just to, briefly touch on CECL. I mean, CECL's been around, people have, it's been talked about at conferences. It really affects the banks a lot more than it affects independent mortgage companies. So I mean, Austin, do you want to jump into? Do you want me to cover it a little bit? I really don't care. I mean, I can do it and I can chime in.
Sure, I'll
whatever-
give
whatever
a
you think.
quick overview.
Yeah.
So pretty much under historical GAAP and through, last year, this will be the first year this is really changing. You didn't recognize related credit losses until it was probable that you had incurred the loss. And once you did recognize that, it was written down and there wasn't much else you could do if anything else changed. So you were very, it's funny to say conservative in booking losses, kind of the opposite of the way we normally in accounting, but it was kind of a higher bar to recognize losses, and you were really only looking historically, not much, if any, forward-looking analysis going on. And so that's mainly what this has really changed. It's a big change to a forward-looking approach, because now, rather than just amortized cost and then thinking about whether or not you had incurred a loss, now right up front, it's the requirement to book things at expected cash flows, expected future cash flows, incorporating any expected losses. Another key change is that those losses, when recognized, you'll book and record into a valuation account that will net against amortized cost. And that allows you, and now you actually have the ability to reverse those if things change, if credit conditions actually improve. Whereas before, once you book that loss, that was it. So now you can actually, reverse that, and that change would flow through the current income statement, and that should help things better align with credit changes as they occur during different accounting periods.
Yeah,
Again, for
sorry,
go for it, Dustin.
No, I was probably gonna say the same thing you were about to say, so go for it.
I was going to say again for our client, this in mortgage industry, it's mainly going to affect loans held for investment, mainly because your loans held for sale, various others are already booked at fair value, so it doesn't necessarily really apply to those. So it's really going to be zooming in if you've got a large portion of loans held for investment and you're holding those at cost. You really need to, analyze those. You can do it loan by loan, or if you have a good number, you can look at that as classes of loans or the similar types and do it by group and try to forecast those out based on similar credit conditions and basically what you expect those cash flows to be in the future. They didn't give, there's no specific methodology, so it really is, up to companies and management to come up with the best estimate that they feel based on current conditions of the loans that they're holding.
So I guess with that, I mean, Mark, I think you're coming back on here in a second, just to kind of close this out. I mean, I guess thanks guys for all that. I think there's a lot. Again, thanks for everybody staying on. If there's any questions, definitely let us know. But Mark, go ahead. You can take us out of here. So
yeah, no, some really great recommendations to consider as the year comes to an end. it's always good to keep in mind to make sure that you're letting our team know what you're planning and what you're going through, so we can help guide you through all these various things from tax, audit, and accounting. We're really here to support you. I want to thank you all for joining us today. I'm especially thankful to showcase some of our amazing leaders at CWDL. I want to thank Lucy, who joined us from Texas today. Austin, who joined us from the Bahamas today. Holy smokes, thanks for joining us. And then Nadia from New York. So I really appreciate that. I want to also thank Casey for the intro and Dustin for moderating today's session, and Rachel for all the planning and setup. I know she's kind of one of these unsung heroes that works in the background and makes all of this possible all the time. So thank you, Rachel. As we come to the end of the year, I want to thank our team. We've expanded some of our services this year. We added Paul Hubbard to kind of round out our CFO consulting practice, and he's been a great addition. And also with our partnership with First Line Compliance, allowing us to do a whole lot more compliance support for our clients. So really thankful for all the new things that we're doing. Looking forward to next year and continue to navigate this industry that we're so appreciative to be a part of. So with that, at the end of this webinar, we're going to have a survey that goes out. If you could take a couple minutes to fill that out, I would really appreciate it. And let's see, what else am I forgetting? Rachel's probably sending me a message. But I think that's it. So thanks so much. Happy holidays. Hope you all have a wonderful time with family and friends, and looking forward to next year.
Thanks, guys.
Thank you.
Thank you.
Bye.
Okay.